Hello and welcome to Fireside with a VC. I'm really psyched today to have my old friend, Alex Moore on the podcast. Alex, amazing, quick, fast-paced career, went straight from Stanford to Palantir, where he joined Joe Lonsdale. I think you guys were in one room starting that company, so every founder can relate to that. So he was the first employee there, director of operations. And Palantir, if you don't know who that is, you probably shouldn't be listening to this podcast. They turn that into just a multi-billion dollar company. It's kind of like the poster child of what an AI company can be and how to solve a million problems, and really probably change the course of history. I funded 2 out of Alex's 3 startups before he became a VC. One was Backplane, which was co-founded with Joe Lonsdale from Palantir again, along with another good buddy of ours, Matt Mickelson. We then funded him again at Nodeprime, and I think I introduced you guys to Albert Kim at Ericsson Venture Partners, who became a customer, became an investor, and ultimately acquired that company. So Alex has got a long-standing great track record before becoming a venture capitalist, keeping the band together with Joe Lonsdale. And like me, as a COVID migrant, we migrated to Austin, Texas after being in Silicon Valley for a long time. So Alex, great to see you. Good to catch up.
Happy to be here. Very excited to talk about what we're up to and what's going on in defense and other areas we're working on. Thanks for having me.
Yeah, awesome. So quick word from our buddy Mark, who'll introduce Venture Debt, and we'll just get right back into the pod.
Hi, everybody. This is Mark DiTargiani. I'm with Pacific Western Bank, and we are a bank focused on helping startups grow and get to the next stage. We've been working with Andrew and 7BC for years now. Andrew and I go back a decade and a half at this point, and I've always respected the fact that he's a thought leader in the space and somebody that you can learn an awful lot. And he kind of opens up that window a little bit into VC and what's happening in the back room. So we're excited to be partnered with Andrew on his podcast here at Pacific Western Bank. We focus on helping startups get to the next level. We offer a startup services program for companies that are the pre-A, which includes some free banking and some high yield interest rates. And then when companies raise an A round, then we start moving into treasury management services and then venture debt. And we believe that we're one of the leaders in the venture debt market because we are flexible and we can do custom packages and we don't just do off the shelf type of term sheets. So enjoy the podcast. It's going to be a lot of fun. You're going to learn some things, and we'll see you on the other side.
Thanks, Mark. And anybody who needs an introduction, happy to share your information with them. Just get in touch with me and I'll put you in touch with Mark. Thanks so much for supporting and sponsoring the pod. So Alex, within venture capital and within 8VC, I understand that you're running both like an incubation program as well as your defense practice. Can you tell us a little bit of the story of 8VC and how you're set up? I mean, you guys, I remember you hit Oculus really early, sold that to Facebook, and it seemed like you had just closed a fund when you guys were in like University Avenue there in Palo Alto, and then bang, you raised another big fund. So maybe tell us the story. You know, I kind of think of you guys a bit like, every now and then you've got like a founder that's iconic, becomes a billionaire, like Mark Andreessen, Peter Thiel, and then like Joe Lonsdale coming out with you with Palantir. It was one of those kind of overnight big fund. But maybe tell the story of 8VC, and then we're going to focus on what you're doing there.
Yeah, that'd be great. Yeah. So I think the origin story here is actually, Joe had set up a sort of a previous iteration of the firm called Formation 8, which I was not a part of. And then that was the group that caught like the Oculus investment. And then at some point he made a decision to sort of split off from those 2 partners. They each set up their own funds. Joe came over and set up 8VC, which we're now, I joined in sort of at the end of Fund 1. We're about to launch Fund 5. About $6 billion under management. I think basically you could abstract away the thesis of 8VC as basically being a venture capital firm, more or less built around some of the thesis that we had at Palantir in the early 2000s, which was every industry is going to sort of need like a data platform that's really smart, where you're sucking up all the data for an industry. You're specifically building the software for industry. So like vertical software, not horizontal. And that you're sort of automating workflows for an analyst, or in other ways, tackling some of these sort of, infrastructure like problems that specific industries have. And that goes, and I'll give the short version, but basically each industry probably needs its own data ontology. Palantir was sort of what we have called like a flexible ontology. So we sort of, Palantir is a larger company. They can build out, sort of more specific type data tech for, depending on who the customer is. But we actually think that you should have like 1,000 of these companies, and that they can be really specific on industries. And insurance should have like an insurtech, or 5 or 10 companies that are built specifically for insurance, as an example. And more or less, APC is trying to invest in and/or incubate companies that go into these specific industries, which are all very individually complex, and build verticalized solutions end to end that can make those industries more efficient. This is sort of like the anti-Salesforce thesis, where you have or the 80s or the 90s, sort of horizontal, everything's horizontal and Microsoft can build everything for you. And we're like, no. Like, actually, they can build some generalized business tools, but you need to have for your industry workflows much more specific types of software that are high end, that are database, that are automating a lot of things. So that's kind of what we do at APC on the large scale. And then we cover a bunch of sectors. And then on top of that, we do things like defense and bio and sort of these other things. And I kind of dip into different parts of the firm in that way.
Yeah, and why don't we drill down on defense first? I remember early in my career, a lot of people were saying, I don't want to get involved in like guns and whiskey being sold to Indians, and I just don't want to get involved in defense. But at the same time, you're paying taxes for like an aircraft carrier that would be the first thing a sub would sink. Like, what are your kind of like philosophical views of dedicating part of your time while you're alive to, tech in defense? Because like, I think a lot of people are just like shut down and get negative when, I'm the opposite.
Yeah, so I think there's like a few things happening, like, and like on one side, there's like this cultural thing in Silicon Valley where there's been like sort of an anti-DoD or anti-defense sort of like thread that goes through, and like the Google engineers rebelling against Project Maven, right? That's kind of like the example. But for me, it's more like actually having like a mission-based philosophy around building companies. So like I went to Stanford September 9th, 2001, and then something happened 2 days later, 9/11, right? And I was like, oh man, like I guess I'm not working on, sort of, I had observed the 90s internet boom, and I'm like, I'm going to get involved in the internet. And it's like, nope, I guess we're going to have to like build a company that solves this problem. Why did this happen? Oh, like our DoD and intelligence IC structure, intelligence community is a mess on the IT side. They have no technology. They don't have any software. It's 2001. Oh my, what can we do, right? So that kind of like is the Palantir piece.
And let's just talk for a minute on that. So like, not everybody knows the origin story of Palantir, or like, I've heard that Osama bin Laden wouldn't have been found had it not been for Palantir, but maybe explain your origin of how you're working with the intelligence community so people can trace that back to understanding how, like generals and all these people.
Right. We started the company in like 2004, 2005, when it was like actually like before I graduated. I graduated Stanford 05, so which was a good year. Steve Jobs gave the graduation speech there, by the way.
Wow.
But yeah, it was, it was a lot, kind of this punky group from Stanford, and then sort of Peter Thiel plus this really smart engineering core from PayPal. The anti-fraud team actually came over, and we kind of like came together and had the baby, which was the company. But it was going after like, really just like big data type, quote unquote, like buzzword, but like large scale challenges there, where the USIC, just the US government was not really making use of like any technology at all, and had all the what we call like silos of data. So a lot of what we're doing was just like getting these like groups to connect databases, like as Palantir is the backbone, and share, and then also creating like sort of the civil liberties piece. So like there's different clearances, so like not everyone should see all the different data, and like you can kind of get access to what you're allowed to see, but more or less create collaborative analytic products that would like allow sort of like the better parts of like intuition and connections to hopefully solve like society's larger problems. So that's like catching Osama bin Laden, that's like finding Madoff's money, that's like cleaning up the banking crisis of 2008, that's like breaking more than half of the human trafficking networks in the Mediterranean with Interpol. Like we do all these things that the public doesn't know about. And we're routinely, like, there hasn't been any big terrorism events since 9/11. Like, why not, right? I don't know, maybe it's because the USIC works now, right? So we had definitely had a big hand in solving a lot of those problems. So like now Joe and I are VCs or whatever, and like I set up other companies which you invested in that are not DoD related, but swinging back around to it now, I think it's like just a super important area. The geopolitical piece, like we have Russia, we have China, like Russia's real now. We had been saying that for 20 years. Now people believe it, people like us. And like China's real, and like now people are starting to believe people like us. We've been saying that for 20 years. So then like, okay, this stuff's real. We're good at technology. And then you kind of have the backdrop is, and then I'll end with the philosophical piece, but the backdrop is we have a defense system that's set up, which was worn by Eisenhower, the military industrial complex. What do we mean when we say that? 4 or 5 large companies that are monopolistic, the Lockheeds, the Raytheons, et cetera. They're good at building hardware. It's kind of like you said, these big format chips and planes and this and that, and they're bad at software. So ding, 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 like we're really good at software in Silicon Valley. Why don't we go in there and help these guys out? And so I think that's actually happening now. I think it was like super uncool defense when we, like, George Bush was president and he was like bombing Iraq when we were starting Palantir. Like imagine you're at Stanford, it's like a very like woke liberal college, and you're like, everyone's like thinks Facebook is cool, and like I want to share photos on my phone, and we were like that's dumb, who gives a shit about that? Like we're trying to solve like world problems here. So we kind of had this little renegade contrarian group. What's happening now is different. There's a much larger group of engineers that think this stuff is cool, and that has a mission. They care about the country, they care about the West, right? Like let's defend Europe a little bit, let's help these guys out, right? With technology, you don't need to run over there with bullets, but we need to give technology to our military that's running over there with bullets or whatever. So
well, clearly somebody did, because you did a lot of recruiting as director of operations and kind of first employee there. And I remember I was living, I was every day walking the streets of Palo Alto at the time that, like, Jesus, Alex has got like that building and that building. When you're going through hyper growth, and I remember paying money for an option to take over this other building across the street, like it was like a real estate challenge of housing all these like Waterloo engineers you were hiring, and everybody in that Phil's Coffee around there was like, it was all Palantir in there.
Yeah, I think there was definitely, and like this was also like I think happening with the Facebook folks, but it was like, let's build things in downtown Palo Alto, let's sit on Stanford, let's make like sort of the environment, like the campus like environment for engineers. So like not only you're just joining this really awesome company that you're working on the hardest data challenges in the world that affect the most critical problems in the world, aka have the most leverage, and also like you're living in this like kind of world where there's a strong culture and you can sort of be roommates with other engineers. And like I think at late 2000s, that was like really the height of that. We were certainly capitalizing on that. I think that on the consumer side, the Facebook people did a great job too. We ended up actually renting out. I did a deal where we took over all of their buildings when they outgrew downtown Palo Alto. So in a way, they actually consolidated the real estate portfolio there, and then we just took it over from them. But yeah, I think we had like a really strong culture. There was a strange thing where it was like you could work on advertising algorithms and photo sharing, and like perhaps that's maybe like the lucrative option. But then like we're working on like the really hard technology and like building and scaling like the largest data sets in the world. And like, we're not just like optimizing advertising algorithms, we're like saving the world or something, right? Some version of it.
There's like,
Yeah,
there's more people enslaved now than there has ever been in the history of man, which is, you think like, slavery's been abolished, but if you're saving someone out of slavery, getting trafficked in the Mediterranean, that's like maybe a little more interesting than supporting Zuckerberg. But another interesting thing about Palantir, which is maybe a roadmap for some other startups and investors, is you had obviously military intelligence, government applications. And if you could find Osama bin Laden, then maybe you could find a bunch of guys that put insurance claims that their pickup trucks have been in accidents. And then you figure out that they were all in Las Vegas last weekend and they all went to high school together and they live in different parts of the country. And you help an insurance company stop, identify fraud like in a way a human could never do. So it seemed like, on the outside, it seemed like you started with kind of intelligence, military, and then you quickly found your way to, financial services and Wall Street. Is that?
I think that's pretty accurate. It's also like this thing where it's like, we're living in the world where, as the Palantir group, or as the ABC group now or whatnot, where like there are like these actual like bad people in the world, or there's like real problems. So let's go like, and we're not in a defeatist thing. We're like, you actually can solve these problems. We don't have to tolerate fraud. We don't have to tolerate coordinated criminal networks, mafias or whatever you want to call them, or gangs, or terrorist groups, or fraudsters. We don't need to tolerate that for our medical system. We don't need to tolerate that for our claims, or military or otherwise, or Fortune 500 marketing, right? It's like, we don't need to tolerate that. So it's actually like a data problem you can solve. So there's this kind of thing where we solved it for the US government, finding needles in haystacks. And actually, it's not just understanding like individual acts of crime. It's more like coordinated, group-wide, fraudulent, larger networks, and cracking those networks. So it's like a Palantir investigation, you might like arrest 50 people across the world in a day, not one person in one basement or something. So it's like this more broad, grandiose way of thinking about how criminal networks work. It's a little scary actually to think about it, but it's also like comforting to know that like Silicon Valley has a group that thought about it and like worried about it, right? So we did that, but now like, Palantir is just a much bigger thing than just that, right? It's like, we also like did a 400
You're still on the board of directors, aren't you? Are you still on the board?
I'm on the board. I wasn't originally, and it kind of brought me out, it dusted me off a little, but I've been on the board for 2 years. But now like Palantir is doing a lot, like more than half of our business is commercial, and it's helping, Fortune 500 companies with various challenges they have. And we do deals with supermarket chains and we help them move their food around, and so it's not just this sort of big scary DoD thing. Although guess what, we're helping a little bit in Ukraine, like wink wink or whatever, or like you can imagine we're involved in at this stage any sort of geopolitical event is sort of some way, like maybe the US isn't using it, but perhaps we've like sold the software to foreign customers, and maybe their government or their version of a group is using it. In certain ways, they have our software or things of that nature. So it's a pretty like broad company. I think it's like actually a much broader company than people think of it as.
Sure.
And in the future, the government business ends up being, a minority, but very, very, very important for society. But for dollars, it's more of like actually the smaller bucket, and the much larger bucket is Fortune 500, and like really just making like solving these data challenges for people and like going full stack on that versus what they do now. They sort of buy 50 pieces of software and try and put it together themselves. And we have like the data lake, and then we have this thing and then that, and then we put it on the cloud, but like that doesn't work. And then we try and Kubernetes. It's like Palantir sort of has a vertical solution that solves all of that. But anyways, we can talk about.
Yeah, we could spend we could talk about the automation of the data center with what you did and us trying to help you at Nodeprime as well. But I want to get back into the venture stuff. But there's so many startups that are, automating human workflows, tapping into data sets in whatever industries. And it's good to know someone on the board of Palantir that could potentially API in with these guys, or maybe even acquire the business. On like market cap, I think Palantir right now is at like 14.5 billion. But what were some peak valuations? Like what was the peak valuation of Palantir as public or private?
Yeah, I mean, I think we like got sucked up in that, sort of like the tail end of the liquidity piece there. So I think like maybe there's a variation where we were like overvalued, quote unquote, so to speak, for a bit there. But then like maybe we're like radically undervalued right now. I'm sure there's other public companies that do technology that feel that way too. So it's always been a long game. I mean, I think this is like an 18-year-old company. I hold my shares in it, or like a large percentage of my shares in it, and you just kind of like, like Oracle took 3 decades to get big, actually 2. So and then we're like 17 years in. So if you look at things at like an Oracle scale, then you're like, wow, the 3rd decade is much more exciting than the 2nd. So it's like this is like mega long-term type thinking, but I think like we're still in that mode. For when you look at valuations, it's like we care about that, but we don't, you know what I mean?
Yeah,
like,
you can't pay too much attention. I mean, it's interesting to know, like, the ups and downs on even like an acquisition machine. Do you remember what the peak was? I mean, it looked like it was
like what in the 20s, and then there was like for a minute it was like in the 30s. But I like our that was post IPO before our lockup, so like all of our employees and investors were locked. So like I don't know if that's relevant. You're kind of talking about like hedge funds being creative, or Wall Street bets, or people like that playing in the stock, whereas the holders were locked. I think our lock dropped in like mid-low 20s, and then now we're like much lower. But probably somewhere in the middle of these numbers is like where the stock should be, or something like that, right? It's hard to know. We have no control over that, right? So
let's get back into 8VC now. So with 8VC growing so fast and AUM growing so quickly, how are you guys organized for going after geography, sector, stage? Like where are you guys playing? And anyone listening to this know when they should attempt to hit you guys up as a potential investor?
Yeah, so just like diagnostic of the firm, 7 funds, launching fund 5, I think 8 to 900 million, maybe somewhere in there in a few weeks. And then we're basically in verticals covering what we call bio IT, which is using like computer science for bio in certain ways. Then we have enterprise infrastructure. So these are like 2 formal teams that have like 4 or 5 people on each. Then we have a logistics partner where we've developed, I think, the most complete portfolio for logistics, supply chain, warehouse, e-commerce, supply chain, et cetera, self-driving trucks, yada, yada. And then we have a healthcare person, we have a growth person, and then we have actually consumer person. And then I'm basically the defense, weird hardware, and then seed/incubation person. So we have also developed this program called 8VC Build, where we're differentiating ourselves or attempting to do so from other firms. And we purpose-built 5 to 7 companies per year. It's the opposite of the YC model. We don't put in 200 grand, we put in 10 million. We hire the founders or AERs, come to us, we build with them. And then we're looking for basically large industry gaps that we're high conviction on, and then building out complete solutions to those. So like hence the 10 million, very high conviction. And we've rewritten our LP charters to put 25% of our dollars into this. So when you talk about a fund that has a 2 or 3 year life cycle, it's 800 million, and then 200 million of that is going into like incubating. So this is like a pretty high conviction practice. Some of this
also, it's a bit like some of the dynamics of those businesses that you guys are building almost feel like they have the characteristics of semiconductors. Like you need to spend 50 million to see if the semiconductor thing even works. And then maybe another 25 million to have like 24/7 guys staying in a Shangri-La in Taipei in the fab until the fab gives it the thumbs up. And then boom, everybody wants to buy that and push it into every fab in the world. Not every like SaaS, I was thankful you brought me into Nihilus. That was a great deal we got to do together. But like, you're not dealing with just Nihiluses that are, these highly scalable, capital efficient companies that you can predict revenue growth and valuation moving fast. Maybe talk a little bit about that, because I think you guys are optimistic to take on tough stuff, but you're also able to raise money and do these long March fights for that. And
Yeah,
government sales is generally like a bitch, right? Like
yeah,
government sales is usually a tough one, even though you know a lot of people, but
yeah, it's really tough. I mean, so but yeah, we've incubated now like 17 or 18 of these, and I think like a subset of them are these sort of larger dollar investments. And like an example of that's like Epirus, where we're doing building directed energy platform for the DoD. And we just, we're making amazing early progress on that. But that's, that company has over 100 patents. We basically have take a directed energy from like something that's the size of a tractor trailer, which is like the crappy product the Prime's made. We have something that's about the size of a picnic table, that's radically more powerful and can do a lot of things. For example, taking drones out of the sky, which is sort of the number one thing you'd want in like a warfare situation. So that's a solution that will give, the US and allies a generational advantage against adversaries, hopefully working in a way that deters. So like, maybe if you're Russia, you don't want to attack Ukraine. If we have the Epirus solutions there, it'd be like very unfruitful to attempt to do so. So in the future, so we have a few like that. We have a company called Resilience Bio, where we're rolling up all the biomanufacturing facilities in the United States. They're doing things like producing Moderna vaccines in these facilities and a lot of other things. And it's sort of like, that's a long-term thing. It's like, we should probably have the bio industry, like including like making vaccines and such, be physically located in the United States. What does that cost to do? It costs a few $1 billion because you have to go buy up these facilities and upgrade their technology and hire up hundreds of people and technicians and train them. So those are kind of the bigger, chunkier projects. But we also do have, so sort of more traditional looking vertical SaaS businesses that come out of the incubation program. I have a vocational training program where we're building like the sort of the future of trade schools, and we're training people to work in all these factories that are being reshored. So we have stuff that looks like that.
Have you heard of Finn? Do you know the company Finn? FYNN?
I have not seen that company yet.
I'll show it to you afterwards. It's a company we invested in a couple of months ago that provides capital for people to go to trade schools. So it's like a little bit like you got like Lambda School, which is now Bloom, is train everybody to be a software engineer. But what about people that need a loan to go through boot camp to become a nurse or an auto mechanic or fixing air conditioning units and all that kind of stuff? But anyway,
that's how we solve societal problems, right? It's like, let's up level our workforce. That rebuilds the middle class. We have this thing with like where we shipped all of our middle class, all of our factories overseas for some stupid reason in the 90s. We have to restore that. We have to bring the factories back. Now we have to retrain the next generation of workers to work in those factories. So yeah, like I commend you for making that style of investment. Number one, I imagine there's a lucrative upside. And number two, it solves a very real problem for society. There's a lot of people in pain in the middle of this country that we need to help out.
Yeah, I mean, that's like, it's a company with, if you just like work in as a sales trader in Wall Street, you have like a bad day at work, these guys will get in the elevator and change companies for 1 basis point. Like there's no loyalty to the mission of being the sales trader at whatever X firm on Wall Street, and that might be the case if you're working in advertising or photo sharing, at some of those big companies in the Valley. But if the company's got a mission, it's more likely that employees are going to, get through some choppy waters and stay together. And so a company with a mission, I think sometimes has, better financial outcomes. But Finn is the revenue model of it is crazy, how quickly they make money and the way the cash moves in this business. That people don't need the money, that they don't have to take it. But it's not a philanthropic company, but it does have a double bottom line. Let's talk for a minute about like what the pizza pie of equity looks like in these deals and any challenges of incubation. Like I remember the Samwer brothers. I know all three of them in Germany, and they would create a company, recruit typically a very young team,
right?
And if you basically, it's like you're 2 years in the army of working with the Samwers, and then you go off and probably make more money. But they would own like 80% of the cap table of the company that they incubated, and like venture studioed up. And then when they go to raise money from other VCs are like, yo, there's way too much dead weight in the cap table. This just doesn't look like a benchmark deal where we're going to target 25% ownership in it. On the other hand, if the Samwers sell that thing for, one of these tuck-ins for 50 million and they own 2/3 of it, they might get it's very likely that they're going to get their entire check back. It's just a completely different, approach to venture capital. Maybe what does it look like, and how do LPs, other investors that come in downstream, think about the ownership structures of these deals?
We have pretty strong feelings on this. So like our thought is, if the cap table is weird, like number one, no talented people will work on it. And then number two, no like A+ VC firms will invest on top of it. So that's a non-starter for us. Our deals are usually something like we put in 5 or 10 million. We'll buy 20% of the company for that. We'll take a few points for APC partnership. So like, if like, you might have like me on your board and like I spend a year with you, then like our firm will take like a little bit of points for that. But more or less, like we're ending up around, combined maybe like with the dollars in plus the partnership piece, like 25%, something like that at the most. And then founders need to have like the normal like amount they would normally have. And then, we want to have a larger than average cap table. I mean, I just, incubated a company that had a 22% engineer pool.
Wow.
After dollars in from APC.
And for people who are unfamiliar with this, I mean, the thing about the part of the ESOP, the employee stock option pool, that goes to actual employees as opposed to founders and super important key hires, what ends up happening is that it starts off of like, theoretically that should be 15%. That's what everyone's kind of thinking. Right. But then you end up at a table where you've got the main founders and the VCs, and who's not at that table? Those engineers. And so they end up getting cut down, very often.
Yeah, some of this is set up because I was the first employee at Palantir, not the founder, right? So it's like, I'm like, it's like no one understands these things more than me in Silicon Valley or other first employees of companies, where you're like, whoa, like why do employees own less? And like, it's like these 10 director like level engineer guys like built the whole fucking thing. So like so you want to have like the founders own less, and then you want to have like 10 or like, so people have like 1 or 2%. That's the model we use. And then you can hire anyone. Like I can go in, I can call these people and say, look, man, come build this with me. Here's 2%, even though it's 2 years old, and you're going to get like the biggest rock star ever on engineering. So like, that's kind of the Palantir model. Like, look at, like, it's publicly posted. Like, why do the guys running Palantir own like a third or a fourth of like the guys who run the other companies? Because we follow this philosophy. It's more about the engineers, and like, they're the guys who build it. And also it's also like a greedy retention scheme. It's like, that guy owns 2%. He's like still at Palantir, right? Like from like 20 years ago, right? Because he's like, wow, I like own a ton of this company. And like, I'm not a founder of it, but I came in like engineer 30 and I'm a super genius, and they identified me and gave me the like 6 or 7 other stock packages. So we're more on that train. Like, let's not over glorify founders, but you want to have strong leadership. So you do want to have like the leader owns a lot of it, but not like all of it. And like, the company is not like a monument to the founder. It's like more of a democratic, meritocratic technology institute, where you come in from MIT or one of these smart schools. We teach you how to program for 4 years or 10, and then you can go out and do other things. And now you're really good at engineering and you own a lot, right? And so it needs to, like, we sort of want to replicate that with the build program. And we also just 75% of our businesses, we just invest in companies that have their own traditional structures. So we're not like putting our philosophy on outside, whatever. But like, when we incubate, then it should reflect our internal values. And as a selfish thing, it's like, I would rather own 25% of this really big thing than like 40-50% of this like crappy thing. And then like other smart VCs are like, what is this? And like, this is like weird, it's like, you want it to like look normal. And so the goal is, for me, I use the term graduate. It's like cool when like General Catalyst or like one of these other big firms comes in and like does the growth round at one of these things, and they're like, cap table looks pretty normal to me. Like, yeah. That's a win for us versus like something that looks weird or sort of things like that. So I think that's like our philosophy is also the durable one. Like I don't think it's like, it's smarter maybe, or it's like we're trying to do right by engineers, but like it's also more honest but also retains people. So it's like, in a way, it's like, if you care about engineer retention and building like $10 billion companies, you sort of want to use our model. If you want to build like cutesy wootsy, like $200 million companies, and like the one guy, like you're in love with this one guy who runs it, and you want to like throw away your upside and let him have it. Like, so it's like, I don't know, I'd rather like build this like category killer and be fair. And then like the founders still do well. Like, does he need like billions, or like is less okay? And then like it's more meritocratic and more fun. So it's something like that. I've talked to the guys who run all the other incubators, and we argue. So, but yeah.
Well, that's good. So you've taken the friction out of future financings and attract and retain talent. I think, and you've got that balanced career of like operator and then to VC. I think something that I've learned even from being the VC side and working closely with my portfolio companies was realizing how many engineers we were losing. And sometimes they're in such a hot sector that they're being offered salaries that are just you can't refuse. And how far could we have gone to have kept try to lock them up with a golden handcuff that's not coming out of cash. And so if you're rich on that currency of equity, I think that the whole industry should probably be a little more like you guys to try and create more equity for those key engineers, because when they leak out, it slows down the total self-actualization opportunity, of that company, I think. What do you see as best practices for you guys? And then where do you see the industry on putting a founder on vesting schedules? So I remember myself, I founded a company and our VC came in and put me on a 5-year vesting schedule. And at first I was like, what the F is this? Like, it's my company. You're lucky to be in here, and they were saying like, you want this, Andrew, for your co-founder? Like one of our standard DD questions, doing one of these today, is, has anyone left the company that owns equity, and how much, beyond just show me the cap table, is I want to hear them tell me that story, even. But what do you think about vesting schedules for regular engineers, employees? And what do you think, what's your thinking around putting a founder on a vesting schedule when you're showing up with your check?
Yeah, I think that's right. Like, founders or employees are different. I think for our employees, we're just doing the standard like 4 years, the 1-year cliff, and then like rock stars like immediately like re-up them. So it's like, if you hired someone at like 25 basis points, but they're like someone who should own 1%, sort of like get them there fairly quick. So you're giving them like the second and the third package, and we're sort of like, you're sort of building this arc where they're not like getting this anxiety of like, oh my God, like I'm coming up on my 4-year cliff and stuff. So it's like, we've intersected that. We're giving them the re-up after a year or two. And then like the best people will probably end up with like multiple packages. I think for founders, I think, it's like when the SaaS guys come in, they want the traditional 4-year and then, or something, but like, it's better if it's like longer run to do like a longer term thing. So I think we sort of like try and find truth on those situations, and or we'll sort of like go a little smaller out of the gate. It just depends on what the situation, who the person is. Obviously, it's like someone's like their third company, they have their own ideas, but we're trying to like teach more of like the concepts to the founders, because then ultimately they're going to be building the packages for their employees. So I try and like explain, I'm like, no, like, you don't want to own 25% of your company, you want to own 20%, you want to have that 5%, and like selfishly hire the best geniuses in the world, and they're going to make your company worth 10x, 100x what it would be worth, and then your 20% is now up here. And like, once you kind of like get the light bulb to go off, then like then they'll like enforce that on their own or whatever. So, but then a lot of it is just like kind of the general industry standard. So I don't think we're like authoritarian or or extreme. I think it's just more like, hey man, like think about our philosophy, and then like look at Palantir, like we have evidence and stuff, and then like talk to these guys, and like like, whoa, like the founders own way less than I thought, and then like these engineers own like way more than I thought. Wow. And then like they're like happy, and then that like guy like like hired like 10 of his friends from his PhD program, and then like that they have a whole like AI team now that works on that, and like, oh wow, that was all because you made this decision at the beginning.
And that's everything. That's everything. And if the blood starts leaving the body slows down and dies, at the end of the day. So this also relates to the economy, that if your stock options are deep out of the money, what was a golden handcuff becomes nothing, and people, get a little depressed. what do you think? I mean, nobody knows, but what's your sense? And you guys are probably, I think Joe's podcast is called like the American Optimist or something.
Right.
So you guys are like generally optimists, but what do you think? Like, do you think interest rates are going to go up? Are housing prices in Austin going to be going down? Where do you see the economy going? Right now.
I think like, and then like VCs are notoriously bad at macro, and then like we're all terrible at the stock options trading stuff, and we should just buy like ETFs or whatever. But so like we always get hit on these downturns. We're optimists. Yeah, I think it's just like remaining optimistic. Like interest rates are probably like, or inflation's probably here for like another, end of next year. Maybe we have like 2 bad years is maybe the safer way to think about it. So I think like, how does that translate to startups? Like startups have to be lean and mean, and like a lot of the more frivolous types of things that we're getting financed will hit harder times. And then you want to have like these real sort of quote real companies or whatever, that these things that are building like into the most painful parts of industry, where like you can still get someone to pay you 100 grand for your like data system. So it's like kind of meat and potatoes is sort of how I personally think about it. Back to the basics, meat and potatoes. And like, maybe if we're in like seed and series A and like B. So like for us, like valuations can dance around a little bit in those industries or like in those verticals. And like, there's still like a power law thing. So it's like, we're not like the growth pre-IPO investor. Like those people are in a world of pain, but our things sort of business as usual, and like finding around like valuations hop around a little. But I think like our long view is still like the world needs all of these important systems. Like the software revolution is in like inning 3, not like inning 9. So it's like, we want to see what's next. We want to be a part of it. And there's still just like a large part of our economy that hasn't like had software built for it yet. And so like, it's kind of funny, you like move to Texas and you just interact with like oil and gas people, and you're like, how do you guys pump this oil out? And you're like, whoa, like that doesn't make sense, right? And like, what software you guys don't use much. So you like learn about other industries. And I think with that education, and just like healthcare is broken, like there's just a lot of stuff that the baby boomers have left to us, and low interest rates. You like sort of don't fix industry problems with low interest rates. You just keep the party going, and then interest rates are up, it cuts, and then that's the time where the real software people go like, crack their knuckles and go like, all right, like let's go to work. So I think we're in like a let's go to work moment. It's probably healthy for like the kids coming right out of school who are sort of the entrepreneurial engineers, and it's like crypto really confused that group. And like, but that's kind of like cooled down a little bit. And like, I think crypto is real, of course, and we don't do it, but like, but like maybe we'll get the young talent into like the hard economy a little bit. And there's just like a healthy process that happens. So we remain like cautiously optimistic. We're continuing to write checks. We're launching the $800 to $900 million fund in 2 weeks. So like, we're business as usual. I don't think we're doom and gloomers. Like perhaps we index like the name of Joe's podcast, like we're American optimists. We're sort of like these patriotic, optimistic people that like, are not like, too like, we're sort of trying to cut our own rug a bit, but also like, are being practical with how problems get solved. So there's some like practical element, I think, to software entrepreneurship, where like, what's the problem? Like, what are the 5 features? And then like, oh, this like system's actually really hard to build. That's funny because I have like 10 friends who, if we put them together, we can sort of build that. And like, we're gonna have to spend a year or 2 with you guys, and then we'll go sell it to all your brother and sister companies in the industry and make our own company out of it. So like, I think our bread and butter is still like strongly intact. We're not losing our identities right now.
Sure.
Perhaps much less rich than we were last year. And last year everyone's a rich genius, and now you're sort of left with who you really are, right? So we're pigs in mud, but as always, and like downturns, guess what? Like Palantir, like Palantir is the company that's built for downturns. So we're those guys still.
Yeah, I think that you can be optimist, but you can be practical and say, if there is a downturn, then that oil and gas guy needs that automation, data-driven software more now than ever. So you might have been able to say, hey, I'm Saudi Aramco. I made more profit in Q2 of last year than the FANGs combined. But if things get tough for these companies, they have to listen to that salesperson who says, I can really put you ahead of your competitors. I can lower your costs. I can increase your revenues. It's like, that's a meeting that has to happen tomorrow, not in 3 weeks. So I think there's, a reason to be optimistic. I'm going to close on like just two things. What are you recommending for cash runway when you're funding a company? It's got a burn rate. It's uncertain what the revenues are going to be, but it's certain what their operating plan is to be spending. Where are you guys out of, completed financing? How many months before they hit zero cash? On a cautious plan.
That's like such a really good question right now. And like, I think, and like, I'm speaking as more of like that, like seed incubation guy, right? So I'm like the super early stage type, and we have like a growth guy, we have later stage things at
$10 million checks on day one. That's crazy. I mean, that's theoretically, you could pivot around to a, insanely 4-year, 5-year, 7-year runway,
Yeah, I think there's a lot of wiggle on these early stage things, and we want to get, maybe it's like 2 years is right if you're early, and then if you're a larger company, 1.5 years at least or something is correct. Like you definitely don't want to be like under 1 year of cash right now, then raise right now, but I think that's right. And then like getting comfortable with flat rounds, and like I don't think we've seen big down rounds yet in our portfolio, but a lot of that is we have the luxury of just being that when you're super the early stage, then like this valuation stuff is sort of like less of a thing. And then when you're growth and things go over 200 million, it is quite of a spreadsheet sort of a thing. So, but yeah, I think you want to have like 1.5 years minimum. You want to hire like only really core people. And, so maybe like we're moving into back to like points of truth, and like fundraising is supposed to be hard. Like I love seeing some of my entrepreneurs now are like doing 20 meetings and like getting crushed. And I'm like, hell yeah, I did 50 meetings for Nodeprime, and like we got
and no more like you need to wire by Friday, so we're not going to go through due diligence. Thank God that's over.
Yeah, so it's like the entrepreneurs should eat it a little bit. Excuse me, that's part of being an entrepreneur. Earn your stripes, man. Like get turned down, rub your nose in that. Like I want them to. So I think it's healthy. It's probably quite frustrating, and then like I'm the C guy. I'm like coaching them. I'm like, they said no, let's tweak the deck, like how'd you pitch it, like pitch me, practice on me. So for me it's like cute and fun, obviously painful. And then we don't, if the economy goes down again and you did this interview again, I'd be doom and gloom and very upset, and some of my companies went out of business. That hasn't happened yet. So I think we're still like on this edge where real entrepreneurship pays off, doing the meetings, learning how to pitch, like the Steve Jobs thing, like something around charisma, something around belief, not trivializing the process. And like, I think if your goal is, if you're like this 22-year-old engineer, your goal should not be to like make money. It should be a responsible Silicon Valley citizen. What does that mean? It means you got to start a few companies. It means you got to be like mentoring your peers. You should be spending time back at the school you graduated from. You should be volunteering. You should be helping. You can get around to being a VC later and doing what you and I do now. And like, but get some knowledge and dirty up your hands a little bit. So I think like we'll get more a variation of that now, which is like, music to the ears of like old grizzled Silicon Valley dogs, because they probably like older guys than me were like, you couldn't believe the internet boom in the 2001, or 2000. And like, I lost 90% of my money. It's like, that's how you become an entrepreneur, is not like making the money. It's like eating it and then persevering through the next cycle. So I just think we're moving on a new cycle, reconsolidation, and that should be looked at as opportunistic. And, we all have like psychology and things, and like go on walks and get a dog, but like be tough too.
Yeah. We got to wrap up here, but I think I like minimum 18-month runway, even in good times, because it's good to fund a strategy, a company. You're making a bet with conviction and saying, guys, 12 months, let's hit this hard. We got 12 months to just go for it. And then we have 6 months to assess where are we, and can we run a process the good old fashioned way, which could take 4 months, if things aren't all great, and you've got time to maybe lower expenses, but you've got a year to not have to, worry about knee pads and the distraction of educating some VC who doesn't understand your business like you do. So, and I think when times are tough, I like to see 24 months, because it's just going to be harder and slower. And the founders are against selling that much stock at this low price when they think I'll be growing every 6 months like Palantir, days. But there's that. So final question is on exits. So we had a bunch of companies. I mean, believe me, even my wife is like, damn, these IPOs are getting pushed back at least a year, or the multiples you're getting on M&A right now, is tough. I mean, retail people don't feel as rich as they used to with their 401k, stock market, crypto, gone to hell. But what's your view on, selling a company in the next 3 months or 12 months? We're kind of just expecting no exits.
Yeah, I think we're like trying to build the companies for durability, and like the fantasy. There's always like the human like condition is like you fantasize relief. It's sort of like how the brain works. So yeah, it's probably better not to fantasize relief in this market, and triple down on cultural investments and really getting close to customers, and like that like the customer centric companies that are like good at that are sort of like probably like that's what you want to sort of look like right now is like really spending time. You don't want people to churn, like be like very like caretaking to customers you already do have, and like really taking like relishing like making them happy and things. So like it's more of that kind of a year. And yeah, there's probably not going to be tons of relief points, but then like the economy marches onward, so you just never know when things bounce back. And I think the more like you learn about people, like how they behave in downturns, and like the like kind of good people, like they stick with it and they like don't like get frizzle frazzled, and like they're good to their employees and they're fair, and like that's who you want to be. And then when things go real well again, you'll be real rational, even if bubbles come back into the market, and then like, oh man, I remember the last bubble, and like I'm gonna behave real well, and then behave well in the bubble too, not just when it's bad. So
Sure.
we're all learning and earning stripes, and onwards we go. It's part of the fun of the tech industry. We have cycles, we have disruptions, we disrupt each other, and you're always kind of trying to look around the corner. So that's kind of the fun of it, I guess.
Well, Alex, thanks so much. Great to see you here. I got a couple of deals to talk to you about, and talk about your next fund as well. So good to see you, man. Talk soon.
Cheers.
Well, that was certainly interesting. It's Mark DiTargiani with Pacific Western Bank back here. Again, really excited to be part of the podcast with 7BC and Andrew. And we're excited just to support the ecosystem and help you get to whatever your next step is in your business journey. Thank you very much.